Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at SentinelOne.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So let's set up the anomaly we're unpacking today. Imagine you're watching a stock just completely drop off a cliff.
Right, just a total free fall.
Exactly. You have retail investors running for the exits in an absolute panic, just blindly hitting the sell button. It's, a textbook shoot first, ask questions later reaction from the broader market.
Oh, 100%. But the fascinating part is what happened next. While everyone else is panicking, Wall Street's most conservative analysts are quietly standing at the bottom of that cliff with a net.
Yeah, instead of downgrading the stock amid all the chaos, they step right in and actually raise their price targets, which is wild to see.
It really is. That is the exact tension we are looking at today. It is incredibly rare to see that kind of immediate violent drop accompanied by an almost synchronized chorus of institutional upgrades.
Right. It signals a massive disconnect, basically, between the stock's current market price and the underlying intrinsic value of the company's tech.
Exactly. So today, we are unpacking a hefty stack of analyst notes, technical charts, enterprise software reviews, and market sentiment data. We need to figure out if SentinelOne is, a falling knife to avoid or a rare compounding opportunity.
Right, let's move into the wealth building context.
Yeah.
Because when you are looking at a situation with this much immediate volatility, you really have to zoom out.
You do. We are not evaluating this as a quick intraday trade to flip for a few pennies.
Yeah.
We are analyzing a long-term compounding setup.
Right.
And the foundation of this setup is that the company is currently undergoing a critical structural pivot in how they operate.
Yeah, they're moving away from the classic Silicon Valley playbook. For the last decade, tech companies just operated on this growth at all costs mindset.
Oh, absolutely. They would burn through mountains of cash on aggressive marketing and bloated sales teams just to acquire market share.
Yeah, totally, regardless of the losses. But SentinelOne is actively steering away from that model. They are pushing aggressively towards sustainable profitability.
Which is a necessary evolution, honestly. I mean, the era of free money is over, and the market no longer rewards companies that just incinerate cash.
Yeah, the market has zero patience for that now.
Exactly. But making that pivot requires time, and, it requires a safety net.
And that safety net is their balance sheet.
Yeah.
Frankly, they have built an absolute fortress.
A fortress is a good word for it. They are sitting on approximately $1.05 billion in cash and short-term investments.
Wow.
Yeah. But here's the most important part of that financial profile. They have absolutely zero long-term debt.
Wait, zero?
Zero long-term debt. I cannot emphasize enough how important that zero debt metric is in a high interest rate environment.
Right, because when a company carries heavy debt right now, a huge portion of their revenue just goes toward servicing the interest payments.
Exactly. And if they run out of cash while trying to become profitable, they're forced to go back to the capital markets hat in hand.
Which is brutal right now. They either have to borrow money at terrible interest rates or they have to issue millions of new shares.
Right, which dilutes the value of the shares you already own. By having a billion-dollar runway and no debt, SentinelOne virtually eliminates the risk of shareholder dilution.
That's huge. They can fund their own research, development, and daily operations entirely in-house.
They are completely masters of their own destiny right now. It buys them the operational breathing room they need to execute this pivot properly without being at the mercy of the credit markets.
Yeah, having a massive pile of cash in the bank is a fantastic safety net. It protects you from the downside.
Huh.
But, a safety net doesn't build wealth on its own.
Right. To actually drive compounding value, the core business engine has to prove it can generate cash independently.
Exactly. Now let's look at the fundamentals.
The top line numbers are honestly undeniable. For the fiscal year 2024, Their total revenue hit $692.6 million.
Which is massive.
It is. That represents a 32% year-over-year increase. But more importantly, their annual recurring revenue, or ARR, has comfortably pushed past the $800 million mark.
Let's pause on ARR for a second because that is the metric Wall Street just obsesses over in the software space. Annual recurring revenue isn't a one-time hardware sale.
Yeah, not at all.
It is subscription money that is locked in contractually year after year. Pushing past $800 million in ARR gives them incredibly predictable cash flows.
Exactly, which makes the business far easier to value and manage. But we already established that they are pivoting away from just chasing top-line growth.
Right.
What makes this fundamental picture so compelling right now is the operational discipline underneath those revenue numbers. Their non-GAAP gross margins have expanded significantly to about 77%.
But how are they actually achieving that margin expansion, though? I mean, you can't just flip a switch and suddenly become more profitable without changing the underlying mechanics of the business.
That's a great point. A massive portion of that margin improvement comes from optimizing their cloud infrastructure.
Okay, how so?
Well, in the early days of a cybersecurity startup, you are processing petabytes of data, and your cloud computing bills are astronomical. As SentinelOne has scaled, they have essentially re-architected how their software processes data in the cloud.
Making it far more compute efficient.
Yes, exactly. They are getting drastically better at managing their own internal tech costs, which means more of every dollar they earn actually flows down to the bottom line.
And that relentless focus on efficiency has led to the holy grail for a high-growth SaaS company. Free cash flow has officially inflected into positive territory.
Yes. For the longest time, they were burning cash to grow. Now, the operations are generating hard, positive cash. It proves the business model actually works at scale.
But let's dig into the product itself. Like, why are Fortune 500 companies ripping out their old antivirus software and handing massive contracts to SentinelOne in the first place?
It really comes down to their competitive mode. Specifically, their proprietary Purple AI and what they call the Singularity platform. To understand why this is dominating legacy vendors, we need to look at how cybersecurity used to work. Historically, enterprises used multi-agent security systems.
Multi-agent. Okay.
Yeah. Think of it like a hospital where the cardiologist, the neurologist, and the lab technician all refuse to talk to each other or share patient files.
Wow. Okay, that sounds like a disaster.
Right. You have one piece of software watching the email servers, another watching the employee laptops, and a completely separate one managing identity logins. They are completely siloed.
Which creates massive blind spots. I mean, if a hacker breaches the email server and then moves to a laptop, those legacy systems don't connect the dots until the damage is already done.
Precisely. What SentinelOne has built is a single-agent autonomous architecture.
So, unlike the hospital analogy.
Right. Instead of a bunch of isolated specialists, it is a centralized nervous system. It deploys one lightweight agent across the entire enterprise.
Got it.
So it feels a threat on a remote laptop in Tokyo and instantly tells the central artificial intelligence brain to lock down the server in New York.
And that central brain is Purple AI.
Yes, and it's vital to understand how it operates. It doesn't just send an alert to a tired human IT worker asking them to investigate.
Because that takes too much time.
Way too much time. It autonomously correlates the threat, isolates the compromised device, blocks the malicious IP address, and neutralizes the attack in milliseconds, all without human intervention.
Okay, the centralized nervous system concept makes a lot of sense. But let me play devil's advocate here for a second.
Sure.
I look at the enterprise software space, and technology evolves practically overnight. What is stopping a CFO from looking at a cheaper, newer competitor next quarter and just ripping SentinelOne out to save their department a few bucks? Like, how sticky is this technology really?
The switching costs are astronomically high. You have to look at how deeply this gets woven into a company's infrastructure.
Okay, so it's not a quick fix.
Not at all. Once this single agent is embedded into an enterprise's security operations center, their SOC removing it isn't like uninstalling an app on your phone. It is tied into their compliance reporting, their automated incident response playbooks, and their core network architecture.
So ripping it out would essentially break their daily operations.
It is an absolute operational nightmare. Ripping out a central AI security system requires scheduled network downtime, massive retraining for the entire IT staff, and it exposes the company to terrifying security vulnerabilities during the transition period.
Yikes.
Yeah.
Yeah, no CFO wants to risk that.
Exactly. The sheer pain and risk of switching far outweighs whatever subscription discount a cheaper competitor might offer. Once SentinelOne secures that enterprise footprint, it is incredibly difficult for legacy vendors to ever win it back.
That brings us to the catalyst timeline. We know the tech is sticky and the balance sheet is pristine, but what are the actual real-world events that are going to drive the value of this stock in the near future?
Well, we have a major, immediate event catalyst coming up. In late June and early July, Amazon Web Services is hosting their AWS Reinforce event.
Okay, and why is that significant for them?
SentinelOne's Singularity platform is getting a massive, heavily publicized integration directly into the newly launched AWS Security Hub. They're going to be demoing this integration to a global audience of enterprise decision makers.
We really need to drill down into why that matters, because in the enterprise software world, procurement friction is the absolute enemy of growth.
Oh, 100%.
A lot of people don't realize how painful it is for a massive corporation to buy new software. It isn't just swiping a credit card. It requires months of legal redlining, security vendor assessments, board approvals, and onboarding headaches.
Yeah, it can literally take 3 to 9 months just to close a single contract because of that friction.
Exactly. But if your platform is integrated directly into the AWS Security Hub, it changes everything.
Right.
Thousands of massive enterprises already have massive pre-approved budgets and legal frameworks set up with Amazon Web Services.
So they skip the line.
Exactly. With this integration, a client can often just click a button, deploy SentinelOne across their network, and have it billed directly through their existing AWS account. It bypasses the entire traditional procurement nightmare. It dramatically accelerates their sales pipeline.
Looking slightly further out on the timeline, the next massive milestone is their fiscal Q2 2027 earnings report, which hits in early September 2026.
And the market is going to be dissecting those numbers with a microscope.
Oh, they definitely will. Wall Street is going to be looking for hard proof that management can sustain that positive free cash flow we talked about. Specifically, the smart money will be measuring them against the Rule of 40.
Let's define the Rule of 40 for a second,
Right.
because it is the ultimate health check for a SaaS company.
Right. It is a simple formula. You take the company's revenue growth rate and add its profit margin.
Okay.
If that combined number equals 40 or higher, the business is considered to be operating in the elite tier of software companies.
Right, so if you are growing revenue at 30%, but you have a 10% profit margin, you hit 40. It proves you are balancing aggressive growth with actual profitability.
Exactly. If SentinelOne can demonstrate clear, undeniable progress toward Rule of 40 compliance in that September earnings report, you will likely see institutional investors aggressively expand the valuation multiples they're willing to pay for the stock.
Furthermore, we have serious macroeconomic tailwinds building up behind this sector. We are looking at a very high probability of interest rate cuts in late 2026.
And rate cuts disproportionately benefit high-growth tech companies.
Right. When capital gets cheaper, the complex financial models that Wall Street uses to value companies start placing a much higher premium on future cash flows. A drop in interest rates structurally boosts the valuation of a company that is just stepping into its profitability phase.
And beyond just the macroeconomic environment, there is a massive sector-specific tailwind blowing right now. The Anthropic Claude Mythos narrative recently triggered an absolutely record-breaking rally in cybersecurity ETFs across the board.
We need to define what that actually means, because it sounds like a sci-fi novel.
It really does.
When we talk about the Anthropic Claude Mythos, we are talking about the recent cultural and market realization regarding advanced large language models. Claude, ChatGPT, and others are becoming incredibly sophisticated.
Right.
The mythos is this sudden, widespread realization among Fortune 500 board members that as AI gets smarter, hackers get drastically smarter.
It democratizes cyber warfare. I mean, a novice hacker can now use an advanced AI model to write incredibly sophisticated polymorphic malware, stuff that constantly changes its signature to avoid detection.
Exactly. The market suddenly realized that legacy human-driven defense systems are utterly useless against AI-driven attacks.
Right, you can't have a human fighting an AI.
No. The only way to fight autonomous AI malware is with autonomous AI defense. That realization has caused a massive wave of capital to flow into the cybersecurity sector because the market knows every major corporation on Earth is going to be forced to upgrade their defenses.
Now let's pivot to the chart. Looking at the price structure from a purely risk-aware standpoint, we have to acknowledge the technical damage. The stock suffered a very sharp, violent drawdown.
And it was accompanied by highly unusual after-hours volume. When you see trading volume spike that aggressively on a sudden drop, it isn't just retail investors panicking.
No, it strongly suggests a momentum reset. Massive institutional funds were executing large block trades, effectively flushing out the weak hands in the market.
But from a technical charting perspective, this does not look like a terminal decline, does it?
No, it looks remarkably like a capitulation bottoming structure. We are potentially looking at the formation of a double bottom, which is a classic technical pattern signaling a major trend reversal. And the key piece of evidence supporting this reversal is the institutional response.
Which brings us right back to the anomaly we opened with, the analyst upgrades.
Exactly. The fact that multiple heavyweight analysts immediately upgraded the stock and raised their price targets right after the plunge is incredibly telling.
Yeah, it implies that heavy institutional bid support is stepping in at these specific price levels.
Right. The big funds are acting as a sponge, absorbing that retail panic flow at discounted levels. They didn't see the technical drop as a fundamental warning sign. They saw it as a clearance sale.
And if institutions are stepping in to buy the dip with that level of aggression, it means the underlying narrative on Wall Street must remain highly favorable, despite the short-term chart damage.
So what does market sentiment look like? If we step back and look at it quantitatively, the sell-side analysts are overwhelmingly bullish.
Let's run through that wave of upgrades that hit immediately following the drop.
Sure. Cantor Fitzgerald and Jefferies both bumped their price targets up to $24. Oppenheimer raised their target to $21, and Barclays raised theirs to $19.
Those are not fringe boutique firms. Barclays and Jefferies are institutional bellwethers. When they issue a coordinated wave of upgrades like that, it serves as a bad signal to portfolio managers everywhere that the risk-to-reward ratio has become incredibly attractive.
And beyond the formal, published analyst targets, there is a lot of speculative chatter brewing in the back channels of the cybersecurity community regarding M&A mergers and acquisitions.
Okay, this is where things get really interesting.
Think about the profile SentinelOne presents right now. You have a significantly depressed valuation compared to their historical highs. You have $1 billion in cash with zero debt.
Right.
And most importantly, you have a highly advanced, deeply integrated proprietary AI architecture in Purple AI. There are heavy whispers that this specific combination of factors makes them a prime acquisition target for legacy tech giants like Cisco or Palo Alto Networks.
They want the tech.
Exactly. Those older giants have massive distribution networks, but they desperately want to absorb SentinelOne's autonomous AI capabilities, rather than spending years trying to build it themselves.
I need to step in and pump the brakes right there. I hear the logic, and an acquisition premium always sounds incredibly enticing. But you must never, ever build an investment thesis purely on unconfirmed M&A rumors. I have seen too many investors get completely wiped out because they bought a stock hoping for a buyout, and then the rumor faded, leaving them holding the bag on a company they didn't actually believe in.
That's a very fair warning.
You have to evaluate SentinelOne strictly on its standalone merits and its real-world risks. If the CEO of Cisco never picks up the phone, is this still a fundamentally sound business?
That is the right way to frame it. Now let's talk about the risks.
Because SentinelOne does not operate in a vacuum, the biggest standalone threat here is execution risk. Specifically, their ability to capitalize on their market position while fighting the undisputed elephant in the room, CrowdStrike.
CrowdStrike is the incumbent giant in the endpoint security space. They have massive scale and an incredibly entrenched ecosystem.
And that is the problem. If SentinelOne loses ground in the core endpoint security market to CrowdStrike, or if they fail to effectively cross-sell their existing clients on their newer, higher-margin cloud and identity protection modules, that $800 million ARR growth rate is going to hit a brick wall.
Right, they are playing the role of the agile AI-first challenger, but they have to prove they can consistently take market share from a very well-capitalized giant.
And there's also the existential threat of AI disruption itself.
This is the double-edged sword of the Anthropic Claude mythos. We established that advanced AI creates demand for better security, but as large language models and autonomous AI agents become exponentially more sophisticated, could they essentially commoditize the entire endpoint detection and response industry?
Wow, yeah. What's up to an enterprise CFO from looking at the landscape 2 years from now and deciding to just use a generic open-source AI model to monitor their network, completely bypassing specialized vendors like SentinelOne?
It is a totally valid bear case, but the fundamental rebuttal from the company is incredibly strong. First, regarding the execution risk against CrowdStrike Management's recent successful pivot toward margin expansion, proves they are scaling smartly.
Right. They aren't just blindly burning their billion-dollar cash pile to chase unprofitable market share they can't win. They are focusing on high-quality, profitable enterprise contracts.
They are growing efficiently rather than just growing loudly. And regarding the AI disruption overhang, SentinelOne is fundamentally not a victim of this technology.
Because of Purple AI.
Exactly. Generic open source LLMs hallucinate. You cannot have a corporate security system hallucinating threats. Purple AI is purpose-built, highly constrained, and specifically trained on security telemetry.
It leverages the exact technology that the market is afraid of to make its own platform completely indispensable. They are positioning themselves as a core beneficiary of the AI boom rather than collateral damage. So with everything on the table, what's the final verdict?
Synthesizing the research, the bullish score comes in at a solid 7 out of 10. If we are looking at an elevator pitch for a 6 to 12-month multi-year investment view, here it is. You have a rare, highly strategic cybersecurity asset currently trading at a washed-out valuation due to an emotional short-term market overreaction.
Right.
Yet, underneath that chaotic price action, you have an absolute fortress of a balance sheet with zero debt. You have positively inflecting free cash flow, proving the business model works.
And the tech itself is top tier.
Exactly. You have a deeply embedded AI moat that boasts massive switching costs, and you have a major AWS integration catalyst on the near horizon that will strip away procurement friction.
Oh, it's fundamentally strong despite the chart.
Yes. It is a classic dip buying opportunity where the long-term story of margin expansion and structural profitability far outweighs the temporary fears of a short-term momentum reset.
I want to leave you with one final thought to mull over, completely separate from the financial metrics. We spent a lot of time today talking about how hard it is to rip out a central AI security system once it is woven into a company's network. But think about where the global economy is heading.
It's moving fast.
Very fast. As we move into a future where autonomous AI agents handle more and more of our daily corporate strategy, logistics, and data analysis, the paradigm of security shifts. The next era of cybersecurity won't just be about protecting data from human hackers.
Right. It is going to be about protecting your company's autonomous AI from other malicious AI agents.
Exactly. The company that secures that underlying infrastructure, that builds the central nervous system for AI to AI interaction, won't just be a software vendor. They will be the most vital utility in the digital economy. And the pricing power that comes with that level of leverage is almost impossible to quantify today. If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk. No indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.